Talking about that all day yesterday.
24 seconds away from the opening bell this morning. Good morning. This is what we wanted to hear. A constructive tone from both Russia and the Ukraine coming out of talks in Turkey, and those talks will continue into this evening and into tonight potentially as well. Off the back of that, equity futures elevated on the S&P by 0.9% after a three-day winning streak. Can we make it four? Switch on the board and get to the commodity market. A break of 100 on crude. 99.55, down 6 percentage points off the back of this story. A dollar that's weaker, a euro that's stronger, unlocking a conversation about ECB rate action later this year. Higher bond yields, a stronger euro, 111.27. And if you can explain this one for me, go ahead. There's got to be a head scratcher in the mix as well, hasn't there? 242 on 10s, yields in 4 basis points, and for some reason a bid back into treasuries off the back of all of this. That's the cross-asset price action. We're up 0.8% at the open, about 30 seconds in. Energy, as you would expect, is lagging down 1.3%. Consumer discretionary up by 1.2%. With your movers, here's Abby.
John, well, on this very strong start for stocks this morning, it's a broad-based rally on this optimism over Russia, Ukraine, the possibility of talks. Microsoft, one of the top leaders, up 0.9%, really helping out that tech sector. Interestingly, even though yields are down just slightly, banks higher. Citigroup, one example, up 1.8%. American Airlines up 4.1%. This, of course, is the travel trade rebounds on the thought that peace between these two countries could help international travel. And then finally, General Motors also in on the game, up 3.5%. Again, a very broad-based rally. To your point, John, energy is that lagging sector.
Abby, thank you. The one name to watch is Apple. Through yesterday's close, a 10-day winning streak. That was the longest winning streak since 2010 for this single name. Now it is 11. 11 straight days of gains and adding almost 18 percentage points to that name. The team here at Bloomberg crunching the numbers over the previous 10 days. That's a market cap move of more than $400 billion. And if you want a comparison, that's roughly the same market cap as Walmart. Bloomberg's Ed Ludlow joins us now for more. Ed, what a stunning rally.
Good morning, John. We're up 0.9% right on Apple. We're on the verge of 3 trillion market cap. It's an astonishing story, right, especially when you consider the backdrop of yields, what's happening in Ukraine, the questions around demand. I'm also looking at Amazon, by the way, which is higher because Amazon is the leader of the mega caps on a year-to-date basis. But come with me straight to my Bloomberg terminal and let's talk about this run. If we close higher, as you said, best run since 2003. If we close higher on Wednesday, we match that 2003 run. If we close higher on Thursday, which would be 13 consecutive days of gains, then it would be the longest winning streak in history. And that's interesting, right? You see analysts boosting earnings estimates by around 7% for the year for Apple. They kind of shrugged off the stock, that report by Nikkei, that they'd cut production by 20% on the base model iPhone SE because of waning demand due to inflation and the conflict in Ukraine. What stops this stock? There is a warning in this chart, John, because of course, the last time Apple hit 3 trillion at the beginning of the year, the S&P had a significant drop to follow. We also have yields at 2.5%, right, on the benchmark 10-year Treasury. Apple is not immune from the conversation around higher rates discounting the present value of future earnings. But why is it not immune? It's really interesting narrative. And then we talk about what investors are doing right now. The Nasdaq 100 is still down 7% year to date, but there seems to be this move into quality and growth names. I talked about Amazon being the year-to-date leader of the mega caps, up 2.5% so far in 2022. That seems to be on the back of their own stock split, right, which has given retail investors a reason maybe to look at Amazon, some enthusiasm. Apple almost positive year to date. We're so close, John. But it's really interesting given the backdrop.
Ed, the move in Amazon, never mind the year-to-date move, it's a 25% move off the lows of March. Are you telling me that's just about a stock split?
No, you know, again, just as Apple has done with the consumer products and shown resiliency with the supply chain, Amazon has shown that it is the sum of its parts, right? If there's a slowdown in the .com business, then the AWS cloud business has come in based on recent earnings from prior quarters to save the day. It is a profit machine. And what's really interesting is that there's confidence from Wall Street, even with everything that's going on in the world of consumer, even the inflation story that's going on and higher input costs for companies. Amazon still seems to be able to grow that top and bottom line.
Ed Ludlow, thank you. Ed, looking forward to the coverage for the next couple of weeks. What a rally we've seen in these big names. Ella Hodger, I want to come to you on that, actually. Just the moves we've seen in Apple, in Amazon off the lows, in Tesla as well. What do you think's behind all of that?
Well, the relief, I suppose, on the more positive developments from at least on the Ukraine front. But more broadly speaking, the scenario that equity markets are pricing, which is a little different to bond markets, I suppose, is one where growth is okay. And, as you see the beginning of tightening policy from central banks, particularly the Fed in this case, equities tend to do okay. So despite all the rhetoric that you hear on the 2/10 U.S. Treasuries curve flattening, historically speaking, equities have performed well on that. So it's much more aligned with the idea that we're not in a late stage of the cycle, right? So it depends which school you sit with. So if you're in the late stage school, then probably this should be the last innings of the move. And the volatility that we see in rates markets, which is very elevated still, is actually giving you one of those signals, as is your sort of more classical recession story from the curve flattening. But really, there's a bit of a dichotomy there going on between what bond markets are saying and what equity markets are saying at the moment. So equities are playing with a hope on the better growth scenario, and bonds are getting more worried, say, a year or so down the line.
Sri, you talked about the importance of earnings. Let me share this quote from Citi with you. They said Fed funds have little correlation to the S&P 500 price action. They go on to say, while a modestly negative correlation to multiples is notable, the more interesting attribute is a notable positive correlation to S&P 500 earnings. They conclude by saying this reinforces our emphasis on earnings growth drivers as the key to equity market performance in the intermediate term. So, Sri, let's pick up on that dynamic of earnings. For you, has the outlook for earnings got better or worse since this year started?
Yeah, I'm just going to borrow the thoughts from my equity colleague Mike Wilson here. We do think that the outlook is weaker. And more specifically, when we look at the nature of the earnings revisions that have come through, the point that Mike has been making in recent weeks has been, well, you've seen the downward revision come through in the near quarter earnings, but obviously some payback in the later quarter earnings. That's typically not a healthy sign. That kind of resonates almost with the transient inflation narrative, where we're saying, well, it's going to be bad for the near term, but then it improves very meaningfully. We're not in that camp. But at the same time, we don't think that this is the bond market signaling recession risk, but for the perspective of earnings, it does feel like we are going to be pricing in a weaker earnings outlook rather than a stronger one.
How would you price that through credit, Sri?
A bit more of decompression is what we want to see within the credit markets. What's been most surprising has been our call has been default risk over duration risk. That's played out well, but at the same time, it does feel like the more recent narrative around the next leg of the rate hikes being more significant and more front-loaded, that should really trigger a bit more of concerns around the lower quality portions of the market where the sensitivity to earnings is going to be higher. And at the same time, the impact of higher rates is also going to be more meaningful. So that's kind of why I do think that the more floating rate dependent capital structures plus lower quality companies, those are where we do think more cracks are likely to show up within the credit markets rather than a broad-based sell-off.
Sri, high yield has looked really insulated given what's happening in the world, around the world in the last month or so, but insulated because of the sector mix, so heavily tilted, weighted towards energy. If we do indeed get a de-escalation, and I don't expect you to provide a forecast there, I just want to understand the dynamic, the reaction more broadly in high yield. If you get a de-escalation and energy just kind of backs off a bit, does that leave high yield a bit more exposed?
To some extent, yes, but at the same time, a lot of the correction year to date has been in the higher quality BB, longer duration pocket, which to some extent is likely going to be a beneficiary of that move. So arguably, to some extent, the sector mix hurts the high yield market if we do come off the boil with respect to the geopolitical tension. But at the same time, some of the longer duration, higher quality pockets within high yield are probably going to hold up better.
I just quickly brought up the research from over the weekend from Mike Wilson over at Morgan Stanley, and Aaron Cannon, I'd love your view on it too. Markets priced for a tighter Fed, but not for growth risks. The view of Mike. We're downgrading financials to neutral, given a more late cycle view and forecast for a full inversion of the yield curve in 2Q. 2Q starts this week into next week. Financials will have a hard time outperforming. That's the view from Mike. And let's go with the first line, Aaron. Markets price for a tighter Fed, but not for the growth risks. Does that make sense to you?
Yeah, I think it does, and that's sort of our base case, in fact, which is, you know, the flattening of the yield curve historically augurs or tends to be a signal of heightened recessionary risk. But this time around, because of the unconventional nature of monetary policy, we think that signaling is a bit muddy, and that we may, in fact, experience not a soft landing, but something between a hard and a soft landing, and may just, in fact, avoid that recessionary concern. But I have to go back to the reality that we have disposable, you know, our savings rate is lower. We still have the inflationary pressures weighing on key segments of the equity market. Our expectations are that, you know, earnings are going to disappoint, that we're going to certainly see a significant deceleration of the growth picture this year, and that the Fed is going to, you know, clearly hike rates and hike rates somewhat aggressively. But we think as we move into the back half of this year, as a result of that, the Fed put is going to come back into play, and that could be positive for equities as we move into the back half of the year and into 2023.
How much lower does inflation need to be at the back end of this year for a Fed put to come into play?
It's a good question. We'll have to see how this all plays out. I suspect it'll be a Q4 sort of event. There's a lot going on the geopolitical front that we're monitoring, and the wage picture here in the U.S. is certainly becoming more of a stickier point. So we've been humbled many times by markets. We do think the trend is for inflation to peak here over the next month or two and to trend lower. And we'll have to see how all that plays out, Jonathan.
I'm humbled every day by markets, Aaron. You're not alone. Aaron Kennan there, alongside Ella Hodja and Sri Sankaran as well. About 11 minutes into this, equities up by 0.8%. Energy pulling back, down by 2.9%, now down by 3 percentage points as crude pulls back. A break of 100, a 99 handle early this morning on WTI, as we had a breakthrough of sorts between Ukraine and Russia in talks in Turkey, and those talks will continue through this evening. For the President of the United States, the focus will be on those talks, but also things here at home as well, unveiling his $5.8 trillion budget proposal.
This year we're on track to cut the deficit by more than $1.3 trillion. That would be the largest one-year reduction in the deficit in U.S. history.
That conversation up next.
A firefighter and a teacher pay more than double the tax rate that a billionaire pays. That's not right. That's not fair. And my budget contains a billionaire minimum tax because of that.
The President of the United States there. Happening right now, Secretary Blinken in a news conference alongside his Moroccan counterpart. The first opportunity for the U.S. administration to respond to what we heard earlier this morning. Earlier this morning, of course, a constructive tone coming out of talks between Ukraine and Russia. Ukraine talking up the prospect of the two leaders meeting. Russia talking up the prospect of sharply cutting military operations in and around Ukraine's capital. The dates for the next set of talks not made just yet. This is what we hear from a source close to the Russian delegation commenting on these Ukraine talks. No date, place set yet for the next round of Russia-Ukraine talks. The delegation is leaving Istanbul now after those talks with Ukraine earlier today in Turkey. When we get the headlines from Secretary Blinken, of course, if they're pertinent, if they speak to this story, I'll bring them to you. For the President of the United States, for President Biden, his multi-trillion-dollar budget proposal running into opposition from key Senator Joe Manchin, calling the tax on unrealized capital gains, quote, a tough one. You can't be taxed on things you don't have. There are other ways for people to pay their fair share. Bloomberg's Joe Matthew joins us now from Washington with more. And Joe, I asked this of you this morning, and it's important. Do they want to make policy, or do they want something to campaign on?
Well, it's feeling a lot more like the latter, Jonathan, simply because we've already done this. With regard to the tax on unrealized gains, that was part of the Build Back Better plan that never got its way through Congress late last year. It failed. It was put on the shelf and it was left to die because lawmakers like Joe Manchin don't have time for this. He's not alone either, by the way. Kyrsten Sinema, who you remember looming large in that Build Back Better debate, also has problems with this reportedly. Even the chair of the House Ways and Means Committee, Richard Neal, prefers a different approach when it comes to taxing the wealthiest Americans. This would apply, by the way, to families, households worth $100 million or more, and it's pretty unclear exactly how this unrealized gain tax would be enforced. The issue here, Jonathan, is that one of the hallmarks of this budget, as the president outlined yesterday, was the fact that it was going to reduce the deficit. It would lower deficit spending by $1 trillion. But without that tax on unrealized gains, you can't get that $1 trillion. So there are things that need to be worked out here. By the way, we'll begin officially the process here next hour when the director of OMB testifies before the House Budget Committee. So here we go.
Joe, there's nothing original, as you know, as we all know, about American budgets coming out of the White House that never actually see the light of day. Here's another one. What I don't understand, though, is if you want to get something done, why aren't we having a conversation with Senator Manchin saying, what can we do? Because most people agree with the President of the United States here. Let's get people to pay their fair share. Whispering it down the microphone and coming up with things that won't pass and your own Democratic senator won't agree on doesn't get anything done.
Well, maybe you're getting a little bit closer to your first question, which is no one actually thinks it's going to get done. Look, this is supposed to be a projection or a statement of values, right? The most overused phrase in Washington yesterday. This is it's a laundry list. It's what we believe in. It's almost a campaign speech, if you think of it that way, knowing the White House knows all too well that this will be twisted into a lot of different pretzel pieces before this ever becomes a law. Reminding you, we just passed, lawmakers, 2 weeks ago, the budget, the omnibus budget that we're now operating under. This is halfway through the fiscal year. So if we think this is going to get done before the next fiscal year, that in itself would be an achievement. After that, about a month later, midterm elections. So it's not likely that this is going to see the light of day in its current form.
Hey, Joe. Thank you, buddy. It's good to catch up. Joe Matthew, looking forward to Sound On Bloomberg Radio, Mondays to Fridays at 5 p.m. Eastern Time. We've been watching Apple. A 10-day winning streak becomes 11, and now that 11-day winning streak on Apple erases the losses for the year. Apple stock right now up by more than 1%, the longest winning streak going back to the early 2000s, 2003 to be precise. For a look at some of the names associated with President Biden's budget request, let's get to Taylor Riggs. Hey, Taylor.
John, I just wanted to debate with you instead some of the unrealized gains and how we do mark-to-market accounting on that. But we'll save that for another day. Let's take a look at some of the movers, of course, on the back of some of those budget proposals. I want to first start with some of the biggest increases, right, on sort of a year-over-year basis. We've talked a lot about defense spending on the back of some of the comments about Russia and Ukraine. On the domestic front, a big 32% increase year over year for some of the Veterans Affairs, $82 billion, a 27% jump for Health and Human Services. Commerce also a big gainer, asking for a 31% increase on a year-over-year basis. Let's get back to some of that defense spending, because what's so interesting is they're asking for a 4% nominal increase, 1.5% real growth, but a lot of people and Republicans have come out and said, no, we need 5% real growth. When you think about sort of the inflationary impacts on this sector, Northrop Grumman going to be a big one here, a new B-21 bomber. When we think about some of the nuclear modernization budget, of course, going to that, and a big $130 billion for R&D. That's within the Pentagon's budget as well. Flip up the board, let's also just take a look at some of the transportation as well, because the Federal Transit Administration now going to get an additional $21 billion here, of course. I should say 21, an additional $8 billion. Big money, John, for passenger and freight rail. And yes, ports, as we think about how to modernize those ports, and the big focus here that has been on supply chains.
Do you want to do the accounting thing now? We
Maybe
can
in
always
the
give you some
commercial
time.
break.
In the
How about
commercial break.
that?
I look forward to getting your
And
personal
then do I get
views.
like an unrealized rebate if there's
I
losses?
have no idea how this is meant to work, but isn't that the point, Taylor? It doesn't get done. You talk about doing something, you please someone, you don't make policy. Politics. It frustrates us both, I know. Taylor Riggs, thank you. Looking forward to the commercial break with Taylor, just moments away. Before we get there, let's get you some sector price action with Abby.
John, well, with the S&P 500 up for a fourth day in a row, up about 0.7% right now. Not surprisingly, most sectors are higher, being led at this point by consumer discretionary, up 1.2%. Think Tesla, Amazon, and the like. Technology right behind it, up 1.1%. NVIDIA, Apple, Microsoft. Communication services also higher. Think Facebook, Google, and Twitter. On the bottom, not surprisingly, it is energy. So there's a risk-on mood here on these, the optimism around the possibility of the Russia-Ukraine talks. There's also optimism for the travel trade. Airlines, similar to so many individual stocks, now higher on the year, up about 5%. And it's interesting, John, at this point, the S&P 500 up more than 12% from its February low, and now down just 4% below from its all-time peak. Let's see, are we going to put another all-time high? It seems as though that risk-on mood is here.
Abby, thank you very much. Just working through some of the bond market price action too. 10-year yields in Germany just fading a bit, still up 4 basis points. Let's call it 61. We were positive on a nominal yield on a German 2-year a little bit earlier, above 0. Now negative again by 7 basis points or something like that. Positive about 6 on the session. The Treasury market has flipped. Yields were higher across the curve on 2s, on 10s, much more so on 2s, so the curve was flatter. The spread between the two was narrower. And now yields are lower across the curve, but lower on 10s than they are on 2s, so you can do the maths quickly. The curve is flatter and the spread's still narrower. So the curve is still in single digits on 2s, 10s, 6 basis points, the difference between the two right now. That's the bond market. Let's get you to your trading diary on a better day for Ukraine-Russia talks and a better day for this equity market. Again, from New York, this is Bloomberg. 25 minutes in, we add some weight to this equity market. It's what we all want to see, an improvement between Ukraine and Russia in talks. Will it stick? And can we verify that pullback that the Russians are promising at the moment? The talks will continue on a date yet to be decided, but a constructive tone lifts this equity market. On the S&P, 4,600. On the S&P 500, advancing about 0.7%. Outperformance on the small caps, the Nasdaq up about 1 full percentage point. That's the price action. Here's your trading diary. The President of the United States holding a news conference with the Prime Minister of Singapore at 12:45 Eastern. More Fed speak, Harker, Bostic later this afternoon. More data coming up on Wednesday and Thursday too, with initial jobless claims just around the corner. And on Friday, it is payrolls Friday. The estimate so far, 490K for the month of March. From New York, this was the countdown to the open. Thank you for choosing Bloomberg TV. This is Bloomberg.
From the financial centers of the world, this is Bloomberg Markets with Alex Steele and Guy Johnson.
It's 30 minutes into the U.S. trading day on this Tuesday, March 29th. Here are the top market stories we are following for you at this hour. Progress in peace talks. Negotiators from Kyiv and Moscow make headway while meeting in Turkey. Russia says it's taking steps to de-escalate the conflict, and both sides signal a meeting with President Zelensky and Putin could be coming soon. Swift reaction. Markets are quick to move on the news as stocks get a boost, gold drops, and oil plunges for a second day, bringing WTI briefly back below $100 a barrel. And closer to inversion, all eyes are on the curve as the gap between the 2- and 10-year Treasury yields narrows to single digits, with negative territory looking near. What signal does that send about the U.S. economy?
From New York, I'm Kaylee Lyons with Guy Johnson in London. Alex Steele is off today. Welcome to Bloomberg Markets. And Guy, today the focus is firmly on progress, it seems, in peace talks.
Yeah, but the peace talks are over. How much progress have we really made? The markets, I think, were primed for positive news and certainly seem to be responding to it. There is already significant de-escalation priced into these assets. You look at what is happening with crude, you look at what is happening with European equities, it's been an amazing turnaround. Look at the ruble, basically round tripping to where it was. Let's talk about the data, Kaylee, we're getting on the US economy, because I suspect that this may be a story that we probably should keep a wary eye on. The JOLTS opening data coming through, nice, useful forward indicator as to what is happening in the US labor market, and the number goes higher and higher and higher. The prior number has been revised up, so we're north of 11,263,000 was the prior number. That's now been revised higher to 11,283,000. The current number is 11,266,000. So down on the, up on the prior number, down on the revised number, but up on the expected number. But basically, I think we can probably still say that this is a hot labor market. Consumer confidence comes in pretty much in line with expectations, down on last time, coming through at 107.2. That's the headline number. Current conditions actually looks okay. Expectations are where the real hit is coming through. Kaylee, this is the story. This is a red-hot U.S. economy. The jobs market is incredibly strong. That is what the Fed is going to be focusing on at this point. I wonder whether actually the bigger risk now for markets is not what is happening with Russia and Ukraine, but actually a very aggressive Fed.
Well, and does a de-escalation of the conflict lead the Fed to be able to take that more aggressive action? Yep. Considering it moved 25 basis points in March, it led us to believe, because of the geopolitical uncertainty that is out there, if you remove that, what does it mean not just for the Fed, but the Bank of England as well and other central banks?
Absolutely. Gives them an opportunity to focus on what they want to do rather than, as you say, maybe having to keep a wary eye on what is happening with the geopolitical story. So let's talk about that geopolitical story and get an idea of what is happening. The market's getting very excited today about de-escalation. Russia has indicated that it will sharply reduce military operations near Kyiv and other Ukrainian cities. That comes after the two sides. They've been holding talks in Turkey, seem to be making some progress. The Russian delegation has now departed. There is no ceasefire as such right now. Bloomberg's Ros Matheson joining us now to give us her take. Ros, the markets are getting very excited about the fact that we are now on a road to significant de-escalation. Is that your read of the situation as well?
Well, these talks were supposed to go for 2 days, and after one, the Russians have said they're packed up and they're heading home again. That might be just to report to the capital the discussion so far today, but there was no ceasefire agreed, no humanitarian corridors put in place in a more feasible way, especially in the south. Both sides laid out their positions, which are really far apart still in terms of things like territory that could be in dispute, how those would be discussed, security guarantees for Ukraine, who would give those and under what terms, and so on. So we're quite some way from a broader peace agreement, let alone even a short-term ceasefire. There had been a lot of talk that might come at this meeting in Turkey, and it did not eventuate. Russia did say that it was going to de-escalate around the capital, but it's been bogged down there for weeks and already has been saying that it's going to divert its resources away from that area and focus really on the east and the south, where it's made greater progress. So what it's really confirming yet again is going to concentrate its forces really in those other areas of Ukraine. So it's not a significant move on its part to say it's de-escalating in an area where it was already pretty well stuck. And certainly we had reports just in the last 24 hours that Ukraine was retaking some of those towns in the north. So is it a real big de-escalation? That remains to be seen.
So maybe Russia is just reframing or recharacterizing action it already was undertaking, Roz. But in regard to the opportunity perhaps for President Zelensky and President Putin to meet, which is something Ukraine has been asking for basically for the duration of this conflict, is that an optimistic sign?
Well, there's no great leeway either from Russia that that's something that's going to be on the table soon. What you've got is Ukraine saying that they feel that they've got enough on the table in terms of each side's positions, that it's something that should be taken to a higher level for discussion, because, of course, an overall agreement can only come at the leader level. And they're saying that they think that there's enough there now for the two leaders to have a conversation. Whether that conversation does take place remains to be seen. It'll be interesting to see what the Russian negotiators present back in Moscow to their president when they return, and whether he feels now he's ready to speak to the Ukrainian president. So far, he's indicated he has no interest in doing so. Certainly, he would only do so if he felt that he was going to come out of it in an advantageous way, because, of course, he went into this war thinking he was probably going to achieve results very quickly. Instead, here we are in the second month with Russia really struggling on the ground. So he, in order to save face, would need to go into that meeting feeling like he's going to get some tangible gains out of it.
All right, Bloomberg's Roz Matheson, thank you so much on your reporting on this. For more, let's bring in Vygaudas Ušackas, who is the EU ambassador to Russia from 2013 to 2017. He is joining us now. He is also now a board member of the aerospace company Avia Solutions. Vygaudas, what you heard out of Russia in Ukraine today, can that be taken at face value?
Well, I think it's promising that when diplomats meet, rather than, they kill each other and on the front lines. However, I think we cannot be complacent of the first, however promising, signs of diplomatic talks. It's going to be a long path of very uneven and bumpy road, and it will depend very much on what President Putin has in mind and what his final goals at this stage.
Vygaudas, the lie of the land seems to be that Vladimir Putin is, as Roz was just saying, focusing on the east and the south. He maybe is going to look to control the Donbass region and other regions on a long-term basis. He would then find himself with a neutral Ukraine that may be part of the EU. Is that, do you think, the most likely scenario that we are heading towards here?
Well, I don't think whether President Putin has changed his political goals because he still considers himself as on the messianic task to rescue so-called Slavic world from the evil West. Having embarked upon a brutal, unprovoked war in Ukraine, he has confronted with a strong resilience and military capacity of Ukraine to defend its own territory. And I think these past months have shown that Ukrainians are capable to do, and the West will provide any support feasible and possible. So it may force him to reconsider his own the end game, and instead of what initially was perceived as his ultimate goal for the regime change to take over the entire territory. Hopefully he had reduced his ambitions, and the talks which have been taking place in Istanbul will open the door for a more profound and direct talks between President Zelensky and Vladimir Putin.
If Vladimir Putin is reconsidering and perhaps in some ways blinking here as he looks to reformulate his strategy, I'm wondering what role the West then needs to play in a crisis that it maybe is de-escalating. You had previously argued that sanctions weren't enough, that use of force had to be on the table. That is the only thing that Vladimir Putin would respond to. If he already is responding in this way, is that something that you still think would be necessary?
Well, let's be very honest. If not the willingness and capacity of Ukrainians to fight for their own freedom and for our freedom, for European freedom, for American freedom, Putin would have gone with his, bold and crazy ideas to march across the entire continent. And that's why I still believe that the strongest sign the West can provide, and not only to encourage politically and verbally, but to provide military ammunition to Ukrainians to defend themselves, to get NATO and American troops on the ground in the Baltics, in Poland, as President Biden has demonstrated. And that's a force which will force Putin to reconsider alongside the sanctions. I think it was quite remarkable to see that Roman Abramovich was participating in the meetings in Istanbul. It means it hurts even the richest oligarchs in Russia, who may play a constructive role at the end of the day.
Let's talk a little bit about what would happen were a peace deal to be agreed. What is the trajectory of sanctions in that kind of scenario? Would we have to see regime change in Russia for sanctions to be downgraded? How would the sanctions story develop, do you think?
Well, it's a very good question. You know, the purpose of the sanctions, when I was EU ambassador to Russia in Moscow in 2014, when we coordinated with the United States ambassador in Moscow and among EU member states, the philosophy of sanctions is to influence the decision-making, more importantly, the behavior of Russian leadership. I must confess that the sanctions which were imposed up till now did not achieve that goal, as we see what is happening in Ukraine. Having said this, however, we also see a new dynamics. As I said, you know, the sanctions have never been so comprehensively and so deeply and profoundly applied to the Russian economy and to the Russian leadership and to Russian business elite. And that's why, alongside with the military might of Ukrainians, with strong support of NATO, that may deter Putin and to reconsider its own views. What will be the peace deal? It's still far too early to say. I think it's going to be a long process, which will take not days, months, and weeks, but probably months, several months, if not, I mean, an entire year, as it really, I mean, will represent a set of very difficult questions, which especially Ukrainians have to respond. What's going to be the fate and status of Donbass, Donetsk and Luhansk region? What's going to be the status of Crimea? And what's going to be the status in terms of Ukrainian aspirations? I mean, at the end of the day, that's what revolution was all about in 2013 and 14, to honor aspirations of Ukrainians to be part of European Union and NATO.
Vygatas Ušackas, sir, thank you very much indeed. The former ambassador to Russia and Avia Solutions board member, thank you very much indeed. We are getting some comments from Antony Blinken, the US Secretary of State, the one that stands out to me. We're not seeing signs of real seriousness from Russia. We'll continue to monitor the heads. This is Bloomberg.
The war in Ukraine rages on.
Ukraine will never be a victory for Putin.
What is happening is a genocide of Ukrainians.
Putin must fail.
Turn to Bloomberg for up-to-the-minute reporting from around the world.
1.2 million people have crossed into Poland.
The Children's Hospital, the latest target.
Putin has gone all in.
And analysis of what it all means to you.
The corporate exodus continues.
For every dollar the United States could lose, the European Union stands to lose 10.
Keep it tuned to Bloomberg Television and Radio.
Okay, let's talk about our question of the day. Is it too soon to price in a peace dividend? Let's talk about it. Bloomberg Markets editor for EMEA, Christina Kino, and Bloomberg Market strategist, Vince Signorella, joining us to discuss. Christine, I've got the CAC Heron's up by nearly 3%. The DAX is up by 2.5%. We're fading, but the FTSE 100 is only up 0.8%. You've got a bond market move. We're certainly seeing yields coming lower. Certainly the US 10-year down by 6 basis points. Right reaction? Too much? Your take on what we're seeing on the screens in front of us.
Well, Guy, the reaction in Europe absolutely makes sense when you consider the proximity of European markets to what's going on in Russia. You know, before all of this, we know that Europe was one of the biggest losers if, in fact, things escalated here, given that Russia, of course, is its biggest supplier of energy, and that was going to be a big issue for European economies to find an alternative source. And so the positive reaction makes a lot of sense. This is why we're seeing the outsized reaction, particularly in Europe. But again, let's remember, there's nothing actually concrete that came out of these talks, no concrete agreement, a ceasefire, but markets are just ready for good news at this point, Guy.
Well, and that's in the equity market, Christine. Vince, I'm also taking a look at oil. Supply was already tight before Russia invaded Ukraine. Obviously, Russia and Ukraine exacerbated the swings we saw. But people already are self-sanctioning. No one is touching Russian oil. I have a hard time believing that is just going to spin and change on a dime once there maybe is a de-escalation of the conflict. So from your point of view, across asset classes, it doesn't have to be oil, but do you think that this is overdone?
Yeah, I think so. I think to answer your question, is it too soon to price in a peace dividend? Absolutely. We still haven't seen any real capitulation from Russia, and what they have said is pretty much, I think what a lot of the strategists I've spoken to over the last month or so have said, that this was really truly a move to take the Russian-speaking Donbass region, similar to Crimea. But you have to remember, President Zelensky's pushed back and has not shown any resolve whatsoever to allow Russia to take any peace. So we're really still very, very far away from a peace dividend. The only capitulation would be if Zelensky says you can have Donbass, and the people I speak to don't see that coming.
Vince, does this actually open the door, though, to a more hawkish Fed? That's one of the key questions that we're trying to kick around and understand here. Central banks around the world have indicated that they are keeping a careful eye on the geopolitics and how that can ultimately influence economic development from here. If you take this risk away, does it allow the Fed in particular to be significantly more hawkish? Shouldn't that be what maybe investors should be worried about right now?
I think it's a really good question. It's a very good point, and it's highly likely. I mean, so the JOLTS data just came out this morning about 20 minutes ago. The job market is still very strong. The quits rate is at near record highs, and the quits rate's coming from the service sector, which is previously what you would think the sort of the lower paid retail restaurants place. People are just leaving those fields for better opportunities. I think the Fed will still walk a little bit on eggshells to see how the economy progresses, but seeing a series of 25 basis points rate hikes going forward, if this would go away, is certainly more likely than not.
Well, Christine, what the yield curve seems to be saying is that the Fed is going to go too hard, choke off growth, maybe even have to reverse course. I'm looking at the 2-10 spread right now. 6 basis points is all that separates short end and longer end treasuries. If the curve inevitably if it does invert, what are the implications of that? How much is that really a signal at this point?
Well, Kaylee, you know, the dynamics of the bond market at present are really vastly different from the previous times that we got these so-called recession signals from the yield curves. Even Jay Powell himself said, you know, he poured some cold water over other parts of the curve and said that it's really the 3-month, 18-month curve that you want to be looking at when it comes to trying to discern the path of the Fed. But I think all this discussion really just brings us home to the point of, you know, the Fed is going to have to really ramp up tightening in the next few months. But then there's always the question of where does that end? Where is the terminal rate going to be? Where is that going to peak? And then what happens after that? Will it be followed by a series of rate cuts? We're starting to see that being priced into markets in about 18 months to 2 years' time.
Vince, let's just come back to this issue of oil prices that Kaylee was talking about. If commodity prices come down, that's going to put more money in the pockets of consumers, money that they are likely to spend. And I appreciate the high oil prices are inflationary, and that's something that the Fed is going to be worried about. But it's going to be worried about the demand boost that potentially you could add on top of already a hot economy in the United States, were you to see significantly lower oil prices from here. Again, I just want to come back to, are we looking at this the wrong way? Does this, if we are going to see this effective wealth transfer from consumer producers to consumers, isn't that something that's only going to accelerate the Fed's need to slow the economy down? And the only way it can do that is by hitting demand, by raising rates.
The problem with that, I think you have to really look at is when you talk about a wealth transfer. With WTI still over $100 a barrel, it's not really a wealth transfer. We're still, oil prices, gas prices, energy prices are still a lot higher than they were 6 months ago. We also have the continuing supply constraints, which is putting pressure on prices as well. So while, you know, the consumer is feeling a little bit better, I do not think, and I've not seen it yet in real earnings where consumers are getting the wage increases to match what is basically 7% inflation.
Yeah.
And if that doesn't happen, you don't really have enough of a transfer of disposable income back to the consumer for the consumer to keep pace. And that puts the Fed in a really bad situation of a potential recession if we see an inversion of the curve or things slow down at a time when inflation is not really backing off that much.
We'll make the wage data interesting to watch within the jobs report on Friday. Thank you so much to Bloomberg's Vince Signorella and Christine Aquino. This is Bloomberg.
It's time now for the Bloomberg Business Flash, a look at some of the biggest business stories in the news right now. I'm Angel Feliciano. Nielsen, the TV ratings company, has agreed to be bought by a group of private equity firms for about $16 billion, including debt. The consortium is led by Brookfield Asset Management and an affiliate of Elliott Management. Nielsen provides audience data services to many of the media industry's premier networks. Shares of Apple are headed for their longest winning streak since 2003. That was when the iPhone hadn't even been launched yet. If Apple closes up today, it would be the 11th straight day. In that time, the company has added about $400 billion in market value. And that's your Bloomberg Business Flash. Guy?
Angel, thank you very much indeed. Kaylee, it's amazing. How many times have you heard this is the moment to get into value? We've been hearing it a lot recently. Doesn't seem as if everybody's convinced. In some ways, maybe Apple is the more logical place to be. If you're worried about inflation, if you're worried about what has happened with the consumer, what's the last thing you're going to give up in this world? Your iPhone, probably?
Yeah, probably, Guy. At least that would probably be the last thing I give up. But it is this whole idea of the flight to quality of companies that are going to be able to continue to earn in an environment of inflation. To your point, we've been talking about value renaissance for some time now. And yes, we've seen spurts of value outperformance. And then it always seems to go the other way. So when will we get one that is actually lasting? We'll discuss the outlook for value relative to growth, the update in these equity markets as we get better headlines out of peace talks between Russia and Ukraine. Joe Gilbert of Integrity Asset Management will be joining us next. This is Bloomberg.
This is Bloomberg.
We are an hour into the U.S. trading session. Better headlines out of peace talks between Russia and Ukraine aiding risk sentiment. Bloomberg's Abigail Doolittle is tracking the moves for us. So, Abigail, we're up, though we are off the highs.
We are off the highs, but yes, we're up. The S&P 500 now up for a fourth day in a row. So the risk on sentiment that we've had over the last 2 weeks extending to today. Some optimism around the Russia-Ukraine war and that there could be peace talks ahead. The S&P 500 up 0.6%. The NASDAQ 100 up 0.7% at the highs, up more than 1%, at least for that NASDAQ 100. Haven bonds rallying, that 10-year yield down 4 basis points, but you could make the case that in terms of that massive backup, we're just seeing some reflexive action to the downside. Speaking to the downside, the 210 yield curve flattening once again at about 7 basis points. Really pretty interesting and very close to that inversion that we're seeing in other parts of the curve. Having no problem going higher, though, Apple now up for a 10th day in a row, the longest winning streak since going back to 2003. At this point now up 17.8%. So this really helps to explain why we have the S&P 500 up more than 12% off of its February lows. The NASDAQ 100 up strongly off of its lows, given the contribution of Apple to those indexes. And it's also very interesting given the fact that there was a negative report yesterday from Nikkei saying they may be cutting production of the lower end phones. The risk sentiment right now is such that investors don't care. They want in on the world's largest company and a top quality company. As for Russian assets, we're seeing a bit of a rebound here. Not surprisingly, the ruble, the dollar against the ruble falling once again, not quite at pre-invasion levels, but coming in quite a bit. And the 10-year yield for the Russian bonds well off of its highs. Although, guys, very interesting. I was looking at the chart, and back in July, it was a 7% yield. It's now a roughly 13% yield off of the peak, but still very elevated, especially when you compare it to the yields here in the U.S.
The ruble charts are absolutely amazing. You take a look at euro ruble, basically back to where it was before we saw the invasion. Such an amazing round trip. Abigail, thank you very much indeed. Let's talk more about these markets, get a handle on where we are. Let's bring into the conversation Joe Gilbert, Integrity Asset Management Portfolio Manager. Joe, Morgan Stanley, Bank of America, the message is stay cautious. JP Morgan says you want to take a little bit of risk here. In fact, you may want to take a lot of risk here. Where do you sit? What is your sort of assessment of these markets? What is your level of conviction on where we're going next?
Well, good morning, Guy. Thanks for having me on. I think that where we sit is somewhere in the middle. I don't think that, I think obviously the way that the year has gone has been, we've been whipsawed around. We went from high multiple, high growth names underperforming the value segment, and then we kind of had to reversal back here, at least over the last couple of weeks. And so I think that it probably makes sense to be a lot more selective and a lot more cautious as we go forward right now. I think that when you look at it, there's a lot of risk out there that haven't fully been priced in, and I'm not certain that the market is really able to price those in or wants to price those in. So I think right now is probably a good idea to be very selective.
Well, on the subject of risks, Joe, obviously one of them has been a war raging in Eastern Europe. The market clinging to the positive headlines today, seeing some buying coming in. Would you be a buyer on a day like today, or is it too early to have confidence in the outcome of the war in Ukraine?
You know, I think that that's a very tough question, Kaylee, because I think that right now there are so many uncertainties, and on a day like today where you're getting, similar, at least we started with a kind of rip your face off rally for people who were short. I don't think that this is actually really the time to really add to risk. So it would be right now I think the market is seeing a lot with its heart and not with its head when it comes to a lot of the Ukraine and Russia negotiations. And so I think that it's better to be a little more cautious, definitely pick your spots, but I wouldn't necessarily do a lot of activity on a day that's strongly up or a day that's strongly down.
Joe, do you see a recession? If so, when does that recession come, and how do you position for it?
Our base case is not a recession. There's obviously tentacles there that, you can eventually talk yourself into it. I think a lot of people are looking at the yield curve, the 2s, 10s, and that's, flattening, and I'm pretty certain that's going to invert. If you look at the 3-month, 10-year, or the 3-month, 5-year, I mean, those are a lot steeper. It probably gives a little bit more of an indication, real economy-wise, of how the economy is doing. So a recession is not really our base case. Obviously, when you have a situation where oil prices have spiked and, oil becomes a larger component of GDP historically, that has led to a recession. But we're in a lot stronger position from the way consumers are, the job market, the health there. And so our base case, once again, is that we avoid recession, but we will have periods of slower growth.
Joe, you mentioned the yield curve, which, as you say, looks like it's close to inverting on Tuesday's 10th. I know you like the financials, and I'm wondering how you can also like the financials in an environment where we're talking not just flatter curves, but inverted ones.
Yeah, that's a great question. And as I pointed out before, financial companies they make their money based on the spread between the 3-month and the 5-year. They're just the lower rate deposits that they get in and then the spread when they loan them out. So overall, the overall mark, the headline is that the 2-10 yield curve is inverting, but actually on the real income statement basis, financials actually will make a lot more money in this environment. That notwithstanding, that it still will be a headwind from a macro standpoint because people will see a flattening curve and that will take away some incremental money that will go into the sector. But we think longer term, the estimate revisions will go up and this will be a place to actually be positioned.
Why do you think so much money is flowing into tech, Joe?
Guy, I think ultimately when we looked at the way the year has started out, we had that huge reversal from tech, the high multiple names into the value names. And I think that what we had here over the last couple of weeks is, I think a lot of investors view tech as defensive. And so when you get in an environment where, the news is not as constructive and you're thinking that growth is going to slow or you end up in a recession, the yield curve is giving you these indications that you may end up in a recession. Tech is seen as a haven and a defensive place to be. We think that tech is actually, important in a portfolio. We're not necessarily as overweight as we had been before. It's good for a barbell approach. But, I think that overall, it still makes sense to have a cyclical tilt to the portfolio, probably not as much as we did have it coming into from last year, but definitely still makes sense.
So that's within an equity portfolio, Joe, and I'm wondering about equities relative to other assets. I feel like the thing I hear most commonly in recent weeks has actually been TINA. That is back to being the narrative. There is no alternative. Do you buy into that?
I'm always hesitant to say when people say that that's the only option, because that means there's probably a lot more options. I'm just contrarian in me. But, ultimately, when people look at, I think people will have a little bit of sticker shock when they open up their, look at their statements at the end of this quarter and they realize that they lost money in the fixed income portion of their portfolio and, potentially if the quarter ended now, they lost money in the equity side of the portfolio. But, less so than fixed income. So I think ultimately in a relative world, equities do provide that ballast and that inflation hedge. So I think that there will be a rebalance that people will, gravitate more toward equity vis-a-vis their fixed income holdings.
What do you think of cash right now, Joe? Is that a place you want to park money if you're losing money in your fixed income part of your portfolio and you're losing money in your equity part of your portfolio? Do you want to have a higher cash proportion in your portfolio right now? A, possibly for safety reasons. B, as well, maybe there's a better entry point coming up. What do you think of cash?
Yeah, I think to the latter point of your question, Guy, definitely cash is, we're viewing cash as very tactically, and we're using it, as I said, to, on opportunities when the market gives us those opportunities of dislocations in pricing of risk, that where we're using it to put it together, invest it and go more into a cyclical tilt. So I think that it's great to have some cash just for the optionality of it right now. Would you hold a little more cash just so you have that flexibility? That probably makes some sense.
All right, we have to leave it there, but thanks so much for giving us some of your insight today. Joe Gilbert, Integrity Asset Management Portfolio Manager. And coming up next, we'll turn to China. Its zero COVID policy doesn't come cheap. Those lockdowns could be costing the Chinese economy $46 billion a month, according to an economist. And on that note, we have some breaking news related to the pandemic, related to vaccinations. Pfizer and BioNTech have gotten emergency use authorization from the FDA for a second booster or fourth dose dose of their vaccine. We're seeing a little bit of share reaction to that. BioNTech is up about 3%, right around session highs. Pfizer, for its part, up about 0.9%. This is an approval for everyone. It has been approved for ages 50 plus, as well as anyone 12 plus who are immunocompromised. But Guy, we kind of knew things were trending in this direction given the spread of more contagious variants and waning immunity from the initial vaccine doses that people have received.
As a person over 50, I'm going to pay attention to this. The question is, Kaylee, how many people are actually going to take it?
Yeah.
And I think that's going to be something that I think is going to be harder the longer this goes on. Every incremental move forward in terms of the vaccination process, I think fewer and fewer people are going to be minded, particularly as we learn to live with this, certainly in the West right now. So I think it's going to be fascinating to see just what uptake looks like, given some of the resistance we've seen, and also just maybe some of the apathy that is developing around COVID right now.
Yeah, I think we're all a little tired of talking about it, Guy, but it's a fair point. There are still a large chunk of people, at least in this country, who haven't even received their first doses. In China, vaccinations, as well as a lack of natural immunity, also an issue. So we'll get back to those lockdowns coming up next. From New York and London, this is Bloomberg.
Keeping you up to date with the news from around the world, here's the first word. I'm Angel Feliciano. Russia will cut back military operations near 2 cities in Ukraine, including the capital Kyiv. That's after the 2 sides held negotiations today in Istanbul. Moscow indicated the talks could lead to a meeting between Russian President Vladimir Putin and his Ukrainian counterpart Vladimir Zelensky. The Senate has now passed its version of a long-stalled bill to help the U.S. semiconductor industry and boost competitiveness with China. This sets the stage for negotiations with the House, which has passed its own version. The measure includes $52 billion to bolster chip manufacturing. And key members of OPEC have a message for the U.S. Trust us. They say that oil prices would be even more volatile if it wasn't for the cartel's strategy. OPEC and its allies, including Russia, meet Thursday to decide on output levels for May. So far, they have resisted calls from the U.S., Japan, and Europe to pump more oil. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Angel Feliciano. This is Bloomberg. Kaylee.
Angel, thank you. Well, let's focus on one country in particular, China. In Shanghai, authorities have cranked up lockdown restrictions for people living in the eastern half of the city. They'll be allowed outside only to get a COVID test. And according to one economist, China's lockdowns could cost the economy about 3% of GDP. Joining us now is Bloomberg Economics chief economist Tom Orlik, one of our resident experts when it comes to the Chinese economy. Tom, China does not seem ready to abandon its COVID zero policy, very willing to lock down its economy, or at least parts of it as a result. How does that affect its longer-term growth trajectory?
So I think that's a really critical question, Kaylee. I mean, we're already seeing with the lockdowns of Shenzhen, of Jilin province up in the north, and now with Shanghai, that the COVID zero strategy comes at some pretty severe short-term costs. The human costs of being locked down and all the stress that brings, but also the economic cost of small businesses not being able to operate, logistics locking down. The question you raise is also an important one. What does this mean longer term? If we think about China's economic miracle over the last 40 years, it's really been a miracle which has been underpinned by engagement with the world. Learning from foreign companies, learning from foreign experts, exporting, importing. Now, a country that stays on COVID zero isn't going to have severe healthcare costs. They're going to dodge the wave of deaths, which has tragically marked the experience in the US and Europe in the last 2 years. But by closing down that gateway with the rest of the world, that creates a drag on China's longer-term development prospects.
Tom, what are we thinking in terms of the policy response to try and offset some of this economic hit? There have been expectations that we would see more, both on the fiscal front and also particularly on the monetary front. What are you guys looking for at Bloomberg Economics over the next 6 to 12 months in terms of the policy response from those authorities?
So the first thing to say here is that 3% GDP cost that we heard quoted from the Chinese academic from lockdowns, I think is both too high when we think about the impact right now. Yes, Shanghai is locked down for people, but the port still operates, the markets still operate, and the lockdown is only planned for a week. So that's not going to cost the Chinese economy 3% of GDP. But it's also too low. If we think about lockdowns that spill out from Shanghai to Beijing to other major cities, well, the impact there is going to be much bigger. So yes, Chinese authorities are prepping stimulus. We expect the People's Bank of China in the months ahead to be cutting borrowing costs, cutting interest rates, cutting the reserve requirement ratio. That frees up more money for banks to lend. And we also expect more fiscal stimulus, a bigger and more front-loaded fiscal deficit for the year.
Tom, because you mentioned ports still in operation, that brings me to the global supply chain, because that is the story that extends beyond China. It's not just confined to China's economy. With every lockdown that China puts into place, is there a waning impact on that supply chain? Has the supply chains gotten more resilient, more used to navigating around that?
So that's a really good question, Kaylee, and I think the answer is not entirely straightforward. China has done better at keeping industry going through lockdowns than it has keeping consumption going. So the restaurants, the hotels, the tourist sites, they're closed down, but the factories and the ports, in large measure, continue to operate. So that means that China's zero COVID strategy hasn't been having the big negative impact on global supply chains that you might expect. Looking forward though, if we see lockdowns expanding, if we see Shanghai staying locked down, if we see lockdowns extending to other port cities like Ningbo near Shanghai, clearly we'd be expecting a supply chain hit. For the global inflation story though, the narrative doesn't stop at supply chains. If we see China locking down more broadly, that's also going to be a big hit to Chinese demand. That's going to hit commodity prices. So you're going to have these two forces moving in opposite directions. Supply chain disruptions pushing inflation up, weaker Chinese demand hitting commodity prices and bringing inflation down.
Tom, can China continue with zero COVID and run the risk of economic sanctions from helping Russia? Is it one or the other?
So there are multiple challenges China's facing right now. They came into the year with a really serious problem with the real estate sector and the default of Evergrande and the spillovers from that. That problem hasn't gone away. There's the common prosperity agenda, the crackdown on the tech firms and all that means for investor sentiment. That problem hasn't gone away. Zero COVID, as we're seeing with the lockdown in Shanghai, is a persistent problem. The other risk which investors are focused on is the risk that sanctions could spill over from Russia onto China. I personally think that risk is low for a couple of reasons. Firstly, I think China will be careful to stay on the right side diplomatically here. They won't be looking to line up aggressively in support of Russia's war effort. The second is that if the US and Europe impose sanctions which are serious enough to hurt China, well, those sanctions are also going to be serious enough to hurt consumers back in Europe and the United States. And we see with Europe's reluctance to impose sanctions on Russian gas that there is a limit to that tolerance to taking pain at home as a price for exerting pressure on Russia.
Tom, really appreciate the input, smart analysis of what is happening here. Tom Orlik of Bloomberg Economics on what is happening over in China. We are getting some headlines coming through from Patrick Harker of Philadelphia. Methodical is the word that stands out, Kayleigh. He expects a series of deliberate, methodical hikes this year. He sees the Fed beginning to shrink its balance sheets fairly soon. Quote, he thinks that he's worried that inflation expectations could become unmoored, but he sees the rate inflation around 4% for 2022. Then it fades, which is interesting as well. But he certainly sees methodical rate hikes this year and the asset program being rolled off, asset holdings basically coming down, QT. And it's going to be interesting to see what impact that has on the shape of the curve. In theory, we could see a re-steepening of the curve, and that may give actually the Fed a little bit more room for maneuver here as well. We'll be back to discuss this more. The European close is not too far away as well. European equities certainly on the front foot. This is Bloomberg.
we are keeping a close eye on the Treasury curve. Inversion on the 2-10 spread is looking closer and closer. Briefly, only 4 basis points separating the 2-year yield from the 10-year Treasury yield. Right now, it's around 5 basis points. This is we're seeing yields on the short end continuing to move up. We're up about 5 basis points on the 2-year today, while yields at the long end are coming down. The 10-year yield is down about 2.5 basis points to 243. Guy, it raises a question. A, is inversion inevitable? Many of our markets live watchers are saying yes, it could happen by the end of this week. But then B, how does the equity market view that? Is it viewed as the recession indicator it once was, or is it able to look through it?
And at what point does that recession bite? And do you want to continue to own stocks until a little bit further down the road, i.e. we get a little bit closer to that recession? The other thing is the Fed's not watching this part of the curve. It's watching 3 months to 18 months, which has steepened, which is interesting as well. So it's going to ignore what is happening here. You think about what has happened with the balance sheet. Does an inversion actually really matter when you've got a balance sheet of this size, which is basically suppressing the back end of the yield curve? And does that get reversed, Kaylee, if we end up doing QT, which we've just been hearing from Patrick Harker, looks inevitable now. So we are going to see QT coming through. We know that's going to happen. On what sort of speed and scale, it's going to be interesting to see. In theory, it should be on rails, but ultimately that should maybe steepen up the back end of the curve. A lot of things going on here in terms of the mix, in terms of the signals that we're getting. European stocks certainly bid on the better news out of the peace talks. We're certainly seeing that sticking at the moment. We did have a positive German 2-year yield a little bit earlier on. We've reversed that, but we are still selling off there. Brent crude down by 3%. European closes next. This is Bloomberg.